Okay, this is the first video for chapter 24 for managerial accounting. We're going to do just an introduction, kind of what the chapter is about, and then we're going to talk about lease or sell decisions. This chapter's got a lot of kind of small pieces to it, so the videos are probably going to be short, but there'll be more of them. So I'm going to try, and the votes that I got were mostly try and shoot between 5 and 10 minutes, so I'm going to try and do that. We'll see how it goes. Okay, so starting on page 1210, really, differential analysis. We're talking about making a decision. We're talking about comparing the differences between the decisions, both revenues coming in and expenses or costs going out. So differential analysis, also called incremental analysis, looks at the differential revenues and costs in order to determine the differential impact on income of two alternative courses of action. Differential revenue is the amount of increase or decrease in revenue that's expected from the course of action compared to the alternative. Differential cost is the amount of increase or decrease in costs is expected from the course of action. The differential income or loss is the difference between the revenue and costs. So revenues minus expenses, basically. Basically, we're making a very shortened version of an income statement here. And then we're going to compare the overall differences between them. So you can see on page 1211, Exhibit 1, you can see the differential analysis between having tables versus having a salad bar for a company. And you see that they have their revenues that would come in for the different alternatives, as well as the costs that would be there for the different alternatives. And then they sum them. The right-hand column is just a total column to get what your total differential is. So in this chapter, we're going to be talking about leasing or selling. That's one we'll talk about this video. Discontinuing an unprofitable segment, manufacturing or purchasing a needed part. We used to call make or buy decisions. Placing a fixed asset, selling a product or processing it further, accepting additional business at a special price. Okay, so lease or sell on page 1212. So for those who are unfamiliar with what a lease is, it kind of depends on the type of lease, but effectively, a lease is a rental agreement, and depending on the contract and what they say in the contract, that fixed asset could go, to the individual after it's done. There could be a bargain purchase option, or it goes back to the individual who leased the asset to you. But something important I want to point out about this decision on 1212 on the bottom. Really, this book doesn't do a great job of using the term, but we're talking about cost relevancy in this chapter. And one of the things about cost relevancy, there's two major really one major leg that this stands on in its entirety. And that is that when I'm making a decision about a differential analysis, the only relevant revenues or costs are those that change across my decisions. So if something doesn't change, then it is irrelevant. So for example, if I had some fixed costs, say I had a building, and the building is going to house that fixed asset, whether I lease it or whether I sell it, and however I do it, I'm going to have that building either way. The cost of that building is irrelevant because, excuse me, because it does not change across decisions. The other thing that would never change across decisions is what we call a sunk cost, and that's what we're talking about on the bottom of page 1212. Sunk costs are costs that have incurred in the past and that cannot be recouped. So there's also no need to take sunk cost into consideration because I can't, no matter which way I go, it's not going to change, namely because it's historic and I can't go back and change my costs in the past. So sunk costs should not be taken into account either. So it gives you an example here, 1212, it says, to illustrate on June 22nd of the current year, Marcus Company considered leasing or disposing of the following equipment. They give us the cost, they give us the accumulated depreciation, they give us the book value. The lease, which is our first alternative, it's $160,000 for the 5-year lease, and then the expenses, the repairs, insurance, property taxes, $35,000, and the residual value of the lease is 0 at the end. To sell, instead, the sales price would be $100,000, and they'd have a commission of 6%. So they've shown all this same information. They've just put it in table form there in Exhibit 2, and that's what we're going to build for our problem that we're going to look at. And you see they just put the revenues minus the cost to come to an income or loss under each alternative, and then they sum across to see what the overall differential on income is. Notice they did not do anything with the cost or the accumulated depreciation or the book value, because those are the sunk costs. The depreciation, the former depreciation, is a sunk cost that can't be recouped. So those do not have to go into my decision-making process at all in this case. So with that, let's look at basic exercise 24-1. And this is the point where I would say, if you want to try this on your own first, I'd recommend it. So you want to pause the video here. Okay, so it says lease or sell. McFadden Company owns equipment with a cost of $475,000 and accumulated depreciation of $280,000. You see, I just put all the information here. That can be sold for $175,000 less a 7% commission. Alternatively, McFadden Company can lease equipment for 4 years for a total of $180,000, at the end of which there is no residual value. In addition, the repair, insurance, property taxes incurred by McFadden would total $35,500 over a 4-year lease. Prepare differential analysis on February 18th. So if I lease the equipment, oh, and by the way, just to be clear here, we're the ones leasing the equipment out. We're the company that owns the equipment, and we're offering to rent it to someone else. So just so we're clear on who we are, the lessee or the lessor, we are the one that we own this piece of property. We have it already. I don't know if it's something we've used or what. It doesn't really specify us. I assume we did, since it has depreciation on it. And we're thinking about leasing it to someone else. So we're looking at, are we going to sell it to them for a cash price, or are we going to lease it to them and basically have rent payments over the next 4 years? So if I lease the equipment, it says that I would receive $180,000 in revenues. Now, as far as costs go, it says that I have $35,500. So I'm going to do a negative number just so I can add. $35,500 in cost, insurance, and property taxes. So I get a total income or loss of $144,500. If I sell the equipment, on the other hand, I receive $175,000 now, and the only cost, from what I can tell, is the sales commission, 7% times the selling price. So for my differential analysis, I'm going to subtract one from the other. And show that it is $18,250 better for me to sell this equipment rather than lease this equipment. Now, this is a future chapter, but arguably you could change these revenues up based on the fact that they're coming in over time rather than a single date. But we don't have that grasp quite as well on time value money quite yet, so we won't worry about that. But there is some other methods we could use for this. But for the purposes of this chapter, this would tell me that I need to sell the equipment because it's $18,000 better financially than to lease the equipment.